Okay, so that brings us to today, a big question when it comes to private market assets, how they are valued. Some may think it's the question. Since they aren't traded daily like public assets, we don't have real-time price information. In other words, how do you mark them to market to understand what they're worth? That question now a major focus of the SDNY's new top cop. Jay Clayton now says he sees, quote, areas of concerns in private markets. Sridhar Natarajan is Bloomberg News chief Wall Street correspondent. He recently interviewed Wall Street's top prosecutor. He joins us here in the Bloomberg Interactive Brokers studio. So let's just remind everybody, he's formerly the chairman of Apollo Global Management, a huge player when it comes to private asset management. He's got some concerns. What are they?
And also, don't forget, he was previously the chair of the SEC.
Right.
So he's coming from the SEC to Apollo to the SDNY. Look, Jay Clayton has been in the news, especially in the last couple of weeks, more to do with the fact that the U.S. Attorney General Pam Bondi has asked him to look into the Epstein file to follow Trump's instruction of going after Trump's rivals. So everyone's been talking about what Jay Clayton will do on that front. But don't forget, as someone running the SDNY, someone atop SDNY, he's also the de facto sheriff of Wall Street. And the theme over the last year, since the return of Donald Trump to the White House, is this idea of deregulation and whether enforcement action will be done. So it is instructive and interesting to hear someone like Jay Clayton talk about the fact that he believes there will be work for his department to do when it comes to questionable activity in private markets. And that's important to us because we've been talking about this also for the last few weeks, this idea of emerging signs of stress, whether that's because there have been some instances of alleged fraud, or if there is a concern that when the cycle turns, when a credit crunch is approaching, an area that has grown so much, when people have unleashed billions of dollars in financing, stepping into the void left behind by the banks, will there be some players there who get hurt? So we've talked about it from the perspective of market participants. We've had academics opine on the fact that because a lot of it happens behind the curtain, how do we truly trust the marks? How do we truly trust the numbers? Now, you have Jay Clayton telling you and telling us that the Department of Justice is going to pay attention to this area because it wants to make sure that when there is a problem, investment managers do not do things that will hurt their clients for their benefit. He's warning them, do not do anything that benefits the house at the cost of investors. And that is an important message and something that a lot of market players would be wise to heed.
Doesn't, though, the private world, the house come tumbling down if they are careless? I mean, what kind of market exists if they aren't careful in their choice of investments? And so when we talk about that there will be some problems, will it just be in any, I feel like, asset class or investment vehicle? There's always some outliers, right? I mean, Sri, but I have to assume, and maybe I'm, being silly here, but these big players, if they don't play it right, I mean, it's going to come tumbling down. No?
Well, that's an important point, right? And you're right. There will always be some outliers.
It's like there's an unwritten contract here.
So when we express concerns and when someone like a Jay Clayton, the top cop on Wall Street, talks about the fact that if there are bad actors out there, he will go after them, that doesn't necessarily mean that the entire industry is flawed. That doesn't necessarily mean that the house will come tumbling down, right? Because there are a lot of tier one players who are doing the right kind of due diligence, and this is a real market that is here to stay. That is not going away. But what it has done is, especially when you go through a bit of a difficult phase in markets, your incentives are skewed in a way where you might do things to make sure that you keep getting your stream of management fee. You keep moving assets from one vehicle to another in a way that they keep making...
This is vehicle to vehicle.
Correct.
Yeah.
So when you move an asset from sort of one portfolio to another, this newfangled trend of continuation vehicles that has absolutely exploded in the past year. We've seen that with private equity assets. We've seen that being embraced by private credit players as well.
So what's the right way to actually value a private asset?
Well, okay, let's talk about the example where you're just moving in from one vehicle to another. Someone like a Jay Clayton would say you should only really get comfortable when there's a reliable third-party mark, when you have another external investor coming in, maybe for a minority, say 20, 30% stake, so that you know that this is real. You're not just trusting the word of one investment management firm saying, this is what it's worth today, we're moving it to another vehicle, this is what it'll be worth tomorrow, so that my existing investors can cash out and we can work out a deal with you guys down the road.
I mean, it's hard. Like my dad said growing up, you'd ask how much something costs, and it's like how much something is worth, however much someone will pay for it.
Exactly.
But if the assets aren't for sale, like, publicly traded equities or anything in the public markets,
you don't know what the price is.
You have no idea what the price is.
And they are very careful, right? Like when I think about whenever we're at Milken, right, and we're talking about terms of deals and stuff, everybody's very careful.
And that's where Clayton is delivering his warning. He's saying that he won't stand for money managers cherry-picking prices that let them reap higher fees at the expense of their clients. What he's saying is the public, the investment public, will want to know that private markets, where there's liquidity offered,
right,
or an asset value-based fee to be paid, right? Think about management fee, are good marks, right? You will want to make sure that those are real and people are being charged appropriately and correctly, because otherwise the SDNY will come knocking, is his threat here.
Vehicle to vehicle, is it illegal?
No, I mean, it's not. If you're a private equity operator and you believe you have a phenomenal asset,
yeah,
but the market's just not seeing it and the capital markets are not great, so you don't have a great exit opportunity. You bought something for $1 billion, you think you can sell it for $2 billion, but the market doesn't exist today. What you're trying to tell people is, we can wait 6 more months. I know my existing investors need to get out, so why don't I put it in another vehicle, bring in more investors?
That's a vehicle of mine.
Yes. So Apollo's Fund A becomes Apollo's Fund B, but that continuation vehicle helps pay off the asset in the previous vehicle. You can see why that sort of a trend could be ripe for abuse. Maybe not at the biggest end of the market where the biggest players operate, the top end of the market.
Yeah.
But go a few layers below and you can suddenly see standards slip.